Friends, consider this. The trade that made gold, silver, and Bitcoin all winners at the same time, it just collapsed. This week, all three dropped hard, all at once for the same reason. The market stopped believing the Fed would cut rates. And when that belief dies, everything that was built on it starts to fall.
Let me tell you how unusual this is. Gold, silver, and Bitcoin almost never fall together like this. Each one usually has its own reasons to go up or down, but this week one single force hit all three at once. The idea that the Federal Reserve might actually raise interest rates again. That changes everything.
And here is the question we're going to answer today. Is this a temporary shakeout, or is the whole story that drove these assets higher now broken? Stay with us because the answer affects gold stackers, crypto holders, and anyone watching AI stocks right now. This is Money Moves, episode 11.
Hey everybody, welcome to Money Moves. I'm Rich the Stacker, and we have a lot to get through today because this week was rough across the board.
And I'm Maya Tech. This is Money Moves, where physical assets meet the digital future. Today, gold and silver hit 7-month lows, Bitcoin drops back to 60,000, a Nobel Prize-winning scientist leaves Google's AI lab, and tech giants plan to spend $720 billion on AI this year alone. Let's get into it.
All right, let's start with gold and silver. Gold is sitting at just over $4,000 an ounce right now, down about 2.5% this week. Silver is under $60, down 6%. Both metals just hit their lowest prices in 7 months. Gold is now down 28% from its January peak. Silver is down more than 50% from its high.
Let's look at what the data says is driving this. The number one factor this week is the expectation of more Federal Reserve rate hikes. Here's what that means in plain terms. When rates go up, the US dollar gets stronger. A stronger dollar makes gold more expensive for buyers in other countries. Less demand, lower price. It is a direct mechanical relationship.
And this is not just a short-term technical move. Jim Rickards, one of the most respected voices in the gold world, has long argued that when the Fed signals it is not done tightening, it pulls the rug out from under gold's primary thesis. That thesis being, gold goes up when the dollar loses value. Flip that assumption, and the trade reverses fast.
Now, the gold to silver ratio is sitting at 70 right now. That means 1 ounce of gold buys 70 ounces of silver. Historically, when this ratio gets elevated, silver is considered undervalued relative to gold. But here is what the data shows. In a risk-off environment where investors are scared and selling, silver almost always falls harder than gold. And that is exactly what we are seeing.
Peter Schiff has been vocal about this pattern for years. His view is that silver's industrial exposure makes it behave more like a commodity than a safe haven during downturns, and that is why it drops faster. Wouldn't that worry you if you are holding silver right now? It should at least make you think about the short-term versus long-term case for the metal.
Respectfully, I think that framing misses something important. Silver's industrial demand is a long-term structural story. Data centers, solar panels, electric vehicles. That demand does not disappear because the Fed sounds hawkish for a week. The short-term price action and the long-term supply-demand story are two different conversations.
That is a fair point, Maya, and I do not entirely disagree. But let me bring in something worth considering. Goldman Sachs and Deutsche Bank both cut their gold price forecast this week. Goldman's new target is $4,900. These are not small institutions. When two of the biggest banks on the planet revise down at the same time, that is a signal the market takes seriously.
And the reason both banks gave for cutting their targets is the same. They no longer expect the Fed to cut rates as soon as they thought. Rate cuts, in simple terms, mean cheaper borrowing costs and a weaker dollar. Gold loves that environment. Take that away. And even the most bullish banks have to recalibrate.
Frank Giustra, the mining financier who has called several major gold cycles correctly, makes a point worth hearing. He argues that the biggest corrections in gold bull markets are often the moments that shake out the weakest hands before the next leg higher. Please hear me out on this one. A 28% drop from the peak is painful, but it does not automatically mean the bull market is over.
Let's look at what the data says about ETF flows because this is critical. ETF flows measure how much money institutional investors are putting into or pulling out of gold and silver funds. This week, those flows were weak, meaning money is leaving. When institutional money exits, it accelerates price drops. That is the mechanical reality right now.
ETFs and futures contracts can move in ways that have nothing to do with the real supply and demand for physical metal. This week's ETF outflows are a paper market event. Physical demand from central banks and retail buyers tells a different story over time.
That distinction is real and important, but I want to be precise here. No large-scale central bank buying or selling was reported this week. So we cannot point to fresh central bank demand as a counterweight to the ETF outflows right now. The data we have this week points in one direction: bearish pressure on metals. Here is the bottom line for the metals segment. Three things are working against gold and silver right now. One, the Fed is signaling rates could go higher, not lower. Two, the dollar is strengthening, which makes gold more expensive globally. Three, institutional money is leaving via ETF outflows. Until one of those three things changes, the path of least resistance is down.
And here is where I land. Jim Rogers, who has navigated more commodity cycles than most investors have years of experience, always says the time to buy is when there is blood in the streets, even if the blood is your own. A 50% drop in silver from its high is painful. It is also the kind of setup that has historically preceded major recoveries. The question is your time horizon.
And that question of time horizon is exactly what separates traders from long-term holders. Short term, the data is bearish. Long term, the structural case for silver in AI infrastructure and green energy is still intact. How do you think this plays out for your own portfolio? That is the question worth sitting with. Let's move to crypto. All right, let's talk crypto. Bitcoin is at $60,000 right now, down 10% this week. That is a significant drop. To put it in context, Bitcoin was at 66,000 just last week after the US-Iran peace deal gave markets a lift. That relief rally is completely gone now and then some.
Here's the thing. The headline from Forbes this week called Bitcoin Situation a Ponzi Scheme Collapsing. That is a strong phrase. I want to be fair, though. Bitcoin has been declared dead dozens of times. The more useful question is, what specifically caused this week's drop? Because the reason matters more than the price.
Let's look at what the data says. Three things drove Bitcoin down this week. First, sharp outflows from spot Bitcoin ETFs. That means institutional investors pulled money out of the funds that hold real Bitcoin. Second, regulatory gridlock in Washington over a housing bill that has crypto provisions attached to it. Third, the same broad risk-off sentiment hitting every asset class right now.
Let me explain what risk-off means because it is important. Risk-off is when investors get scared and move their money out of anything considered risky. Stocks, crypto, even gold sometimes, and into safer things like cash or government bonds. This week, that fear hit everything, and Bitcoin, which is still considered a high-risk asset by most institutional investors, got hit hard.
Now, the Bitcoin ETF outflow story is particularly important. Remember, spot Bitcoin ETFs were supposed to bring stable institutional money into crypto. The idea was that pension funds and big asset managers would buy and hold. But when markets get rocky, those same institutions sell. ETF access cuts both ways. Consider this, friends. The same tool that drove Bitcoin to its highs can accelerate its drops.
And then there is the regulatory angle. A U.S. housing bill with crypto provisions attached to it is stuck in gridlock. Now, why would a housing bill affect crypto? Because in Washington, crypto regulations often get attached to larger bills as riders. When the main bill stalls, the crypto rules stall with it. That uncertainty makes institutional investors nervous about their legal standing.
Respectfully, I think the regulatory story is actually one of the more interesting ones from Reuters this week. They reported that stablecoin rules are softening. Stablecoins are cryptocurrencies pegged to the dollar like a digital dollar. Softer rules there could open the door to much broader adoption of crypto in everyday payments and banking. That is a genuine, long-term positive, even in a down week.
That is a fair point, Maya, and I will give you that one. Stablecoin clarity could matter a lot for everyday adoption, but here is my honest take. When Bitcoin drops 10% in a week and the headlines are comparing it to a Ponzi scheme, retail investor confidence takes a real hit. Confidence is a fragile thing. Once it breaks, it takes time to rebuild. Wouldn't that worry you if you were holding crypto right now?
The data backs that up. Seeking Alpha reported that MicroStrategy, the company that holds the most Bitcoin of any public firm, and APLD, a crypto infrastructure company, led losses in crypto-related stocks this week. When the stocks of companies built around Bitcoin fall harder than Bitcoin itself, it signals that investors are pricing in real fear, not just short-term volatility.
And that brings up an important distinction I want viewers to understand. There is a difference between owning Bitcoin directly and owning a stock that is tied to Bitcoin. When you own the stock, you get extra layers of risk, management decisions, debt levels, company expenses. MicroStrategy has borrowed heavily to buy Bitcoin. If Bitcoin keeps falling, that debt becomes a serious problem for the company.
Three things I want viewers to take away from this crypto segment. One, Bitcoin is at 60,000, down 10%, driven by ETF outflows, regulatory uncertainty, and broad market fear. Two, Stablecoin regulation softening is a genuine positive signal for long-term crypto adoption. 3. The relationship between crypto and traditional markets is tighter than ever. When stocks sneeze, crypto catches a cold.
All right, let's talk AI. And I want to start with a story that I think is more important than most people realize. Alphabet, the company that owns Google, saw its stock drop 6% this week. Not because of earnings, not because of a product failure, because one scientist left to join a competitor.
Let's look at what the data says about why this matters so much. DeepMind, Google's elite AI research lab, lost a Nobel Prize-winning researcher to Anthropic, which is a rival AI startup. This is not just about one person. Nobel Prize winners in AI are extraordinarily rare. They represent the kind of foundational scientific thinking that determines whether a company builds truly breakthrough AI or just incrementally better versions of existing tools.
Here's the thing. The market's reaction tells you something important about how investors think about AI right now. They are not just valuing companies on their products or their revenue. They are valuing them on their talent, their people. In the AI race, the scientists building the models are the mode. Lose one, and the market docs use 6% on the spot. How do you think that changes how these companies operate going forward?
And this talent war is happening inside a spending environment that is almost impossible to comprehend. Amazon, Alphabet, Meta, and Microsoft together plan to spend up to $720 billion on AI data centers in 2026 alone. That is $720 billion in a single year on the physical infrastructure of AI. Servers, chips, cooling systems, power.
Now, some investors are starting to ask a very uncomfortable question. Is this a bubble? The concern is simple. These companies are spending hundreds of billions of dollars, but they have not yet shown that AI can generate profits that justify that level of investment. This week's tech stock volatility, with AI leader stocks pulling back, suggests some investors are starting to take profits and ask that question out loud.
Respectfully, I think the bubble framing oversimplifies it. 3 things to consider. 1. The infrastructure being built is real and physical. It does not disappear if sentiment shifts. 2. Chip prices are rising during a global supply shortage, which means the bottleneck is real demand, not speculation. 3. The companies spending this money have massive existing revenue stream. They are not startups betting on a dream.
I will give you points 1 and 3, Maya, but on point 2, I want to push back slightly. Rising chip prices during a supply crunch can also reflect panic buying, not just genuine demand. Companies buying chips because they are afraid of missing out is not the same as companies buying chips because they have a clear, profitable use case. That distinction matters a lot for whether this spending pays off.
And there is one more AI angle that connects directly to metals, and we will come back to it in the tie together. UN officials are now pressuring AI companies to shift their data centers to renewable energy. The reason that matters for silver: solar panels use significant amounts of silver in their manufacturing. If the AI industry pivots to solar power at scale, that is a new and substantial source of industrial silver demand.
All right, let's tie this whole week together, because what we have seen in gold, silver, crypto, and AI this week is not 4 separate stories. It is one story. And the headline is this: the trade that powered all of these assets higher is now working in reverse. Please hear me out on this one, because it matters for every asset class we cover on this show.
Let's look at what the data says about that trade. The debasement trade, in simple terms, is the bet that governments and central banks will keep printing money and cutting rates forever, which makes real assets like gold and Bitcoin more valuable as the dollar loses purchasing power. This week, the market decided that bet was wrong, at least for now. The Fed is signaling rates go higher, not lower.
Now here's where it gets interesting. Normally, when crypto falls hard, you would expect some of that money to rotate into gold as a safe haven. That did not happen this week. Bitcoin dropped 10%. Gold dropped 2.5%. Silver dropped 6%. The safe haven bid simply was not there. Why? Because the dollar absorbed all of it instead.
And the AI spending story adds another layer. $720 billion flowing into data centers, chips, and cloud infrastructure is $720 billion not flowing into gold ETFs or Bitcoin. Risk capital has a limited supply. Right now, the most exciting story for institutional investors is AI, not hard assets. That is a headwind for metals that most gold analysts are not talking about enough.
That is a point I genuinely had not framed that way, Maya, and it is a good one. Here is my counter-argument, though. AI spending at this scale is inflationary. When you spend $720 billion building physical infrastructure, you drive up the prices of energy, land, equipment, and labor. Inflation, over time, is one of gold's best friends. So the AI boom could be planting seeds for the next gold rally.
I think that is the most important macro insight of this episode. Short term AI capital flows are a headwind for hard assets. Long term, the inflationary pressure from AI infrastructure spending could become a tailwind. And then layer on top of that, the UN's push for AI companies to go renewable, which we talked about. And you have a potential structural demand catalyst for silver specifically.
So where does that leave us net for precious metals this week? The honest answer is bearish in the short term. Rate hike fears, dollar strength, ETF outflows, no central bank buying, no geopolitical catalyst. Every factor we can measure right now points down. But the longer-term structural story has not changed, and that tension is exactly where we are heading into our prediction.
And I want to ask viewers directly, how do you think the AI spending boom ultimately plays out for gold and silver? Is it a long-term inflation catalyst that sends metals higher? Or does it keep pulling capital away from hard assets for years to come? Drop your answer in the comments. We read them all. Now let's get to the prediction.
Before we get into this, we want to be clear. This is for entertainment purposes only. This is not financial advice. Now, the prediction. Maya, given everything we covered today, what is your take on where the macro story goes from here?
Here's where I land. The debasement trade is not dead. It is paused. The Fed can signal rate hikes all at once, but the structural debt levels in the U.S. economy make sustained, significant rate increases extremely difficult to maintain without triggering a recession. My prediction. Within the next 12 months, the narrative flips back from rate hike fears to recession fears, and when it does, hard assets come roaring back.
I agree with the direction, but I want to sharpen the prediction. Here is my concern with timing it to 12 months. The Fed has surprised markets before. If they hike more aggressively than expected, that recession could come faster and harder than most people are pricing in. And in that scenario, gold and silver might actually drop further before they recover, as investors sell everything to raise cash.
That is a fair refinement. So let's land on this together. Our prediction for episode 11, the current rate hike-driven sell-off in gold, silver, and crypto, is a temporary interruption of a longer structural trend toward hard assets. As the cost of the AI build-out creates inflationary pressure, and as rate hike cycles historically end in recession, the case for owning hard assets will reassert itself within the next year to 18 months.
And I will add one specific angle. Silver, in particular, sits at the intersection of three long-term forces: monetary demand as a hard asset, industrial demand from AI's renewable energy pivot, and a supply picture that has not kept pace with that demand. When the macro tide turns, silver may move faster and harder than gold. That has been Maya's call for 2 episodes now, and I am coming around to it.
And I appreciate that, Rich. For the record, this is not me saying the pain is over now. Short term, the data is bearish. But the structural case for silver as the biggest commodity winner of the AI infrastructure era remains our long-term call. We have said it in episode 9, we said it in episode 10, and we are saying it again today. What do you think? Drop your take in the comments.
All right, let's wrap it up. Episode 11. The debasement trade paused hard this week. Gold hit a 7-month low. Silver dropped 6%. Bitcoin fell 10%. Goldman and Deutsche Bank cut their gold targets. A Nobel Prize winner left Google for Anthropic. And $720 billion in AI spending is reshaping where institutional capital flows. Our prediction: this is a pause, not the end, and silver sits at the center of the next chapter.
If you found value in today's episode, please hit like and subscribe. It helps more people find the show. Drop your take in the comments. Is the debasement trade dead or just resting? And tune in next week because the macro story never sleeps. I'm Maya Tech.
And I'm Rich the Stacker. See you next week. Keep stacking.